Hello, Calgary. We've got a great crowd for this upcoming panel. But before we get started, can we just give one more round of applause for all the conversations and great panelists that we've had today throughout the conference? Well, great. My name is Stewart Townsend. I'm part of RBC's Global Private Capital Group, and I advise founders and boards on private capital raises. And I'm excited to moderate the upcoming panel here. And it's going to be a discussion around the role of private capital in the great energy transition. When you think about all great super cycles, whether that's been internet, cell phones, or what we're seeing right now with AI, private capital has played the critical role in really scaling these business models. And private capital's role in energy transition is expected to be no different. So before we get into the discussion today, let's meet our esteemed set of global investors that we have participating in our panel today. So first, let me introduce you to Nishka Gupta, a senior member of ARK Financial's Energy Transition Fund. ARK Financial is Canada's largest energy-focused private equity firm and has raised more than $6 billion to date. Nishka focuses on renewable fuels, electrification, and the wider carbon capture space. In addition to Nishka, we also have the privilege of having Aaron Manz, a senior member of the Ontario Teachers' Pension Plan, a leading global investor with more than $255 billion of assets worldwide. Aaron leads the sustainability and energy transition group within Ontario Teachers' broader equities team. Aaron has been with Ontario Teachers for more than a decade, and while there, he's invested more than $5 billion across the energy landscape. So to kick it off, Nishka, this first one's for you. We're now roughly 2 years into the passing of various government programs across the US and Canada, whether that's the Inflation Reduction Act or the ITC. These programs have provided billions of dollars in government aid for transitioning away from fossil fuel and towards renewable energy and other energy transition sectors. What sectors and business models have you seen make the biggest step changes following the IRA and ITC passages?
Thank you for having me, Stewart. This answer is probably pretty unsurprising for those of you in the room. Electrification of transport and power grids are probably the ones that we've seen the most step change in. For the electrification of transport, whether it's supply of battery storage, the manufacturing, onshoring in Canada and the US, or it's the actual electric vehicle production chains. We've just seen a massive amount of investment go in and more in the pipeline for projects that are announced and planned and in construction over the next 5 years. I think in 2019, before COVID-19 happened, we were looking at maybe a handful of battery plants in North America. Today, I was just looking this up a little while ago, we've got over 36 announced and planned or in construction. So can't say that it's all necessarily coming from the fact that we have the IRA and the ITC, but those policies have had a massive role to play. We've got over a terawatt hour of production capacity expected to come on by 2030, which is enough for 15 or 20 million cars, depending on how big these batteries are that are going into these cars. So just an absolute staggering amount of investment that's planned. The other one would be worthwhile talking about is probably just power grids. So this is on the supply side. Manufacturing in North America for that upstream value chain hasn't really been something that was real or true in the last 50 years, but now we're really seeing that onshoring credits that have been made available with the IRA, whether that's the 45X or the 30% clean tech and manufacturing credit in Canada. You've seen a ton of supply coming on now, and things that were not being manufactured in North America at scale now starting to get manufactured in North America. ARK Financial, we have our own portfolio company that announced a gigawatt-size plant making solar panel cells. They were previously just assembling the modules in North America, and now they're actually manufacturing cells down in South Carolina in a massive plant there.
Aaron, any thoughts there on maybe some sectors that have really taken off following the IRA and ITC?
No, I tend to agree with Nishka. I think it's an interesting conversation, simply because when you talk about electrification, I think that some of this conversation is going to get woven into other things we talk about, Stewart. There is an abundance of need for electrification before AI. I don't even know if the quotation marks are appropriate anymore. But when you think about what's happening with AI alongside EVs, electrolyzers, heat pumps, goodness knows what else, there's a huge need for multiple step changes in how we think about our electricity grid. And even before that, there's a lot to be said about the grid itself just needing to be upgraded, redundancy, grid hardening, things of that nature. So I just think that there are a number of tailwinds behind the electrification megatrend itself.
Yeah.
Maybe just to follow up on that, this isn't just driven by policy, right? There is demand. So electric vehicles, people want to drive them, whether it's hybrids or pure EVs, and people are demanding them in the market. These small blips that we see and these headlines that we read, oh, there's a lot of cars on the lot that are sitting, are small blips. If you actually tally the data of the growth in North America and globally of how many EVs are selling, that data is pretty staggering. Like there's still double-digit percentage growth year over year, and that trend doesn't seem to be slowing down. Same on the power side, driven by some of what Aaron was talking about on the AI. We want electrons, right? I was thinking maybe over the last 2 decades, have we started using less electricity because everything's become so much more efficient? But no, we're using many-fold more electricity. I grew up in India, and I was asking my dad about this, like how much electricity did we consume as a household? And it was a very similar size household. We had electric appliances, maybe not to the same scale today. We had dial-up internet. We had a phone that kind of plugged into the wall. So some of the uses were different, but we were using less than 200 kilowatt hours a month. Today, I look up my NMAX bill. We're using 700 to 800 kilowatt hours a month, and everything is 2 or 3 times more efficient. So that voracious appetite for electrons doesn't seem to be going anywhere. So when you have that marriage of policy with demand, I think that's where we're seeing the massive step change in investment happening.
Maybe taking the other side of that conversation, obviously there's been a huge economic boost from the IRA and ITC, but Aaron, maybe this one for you. There's some sectors that maybe didn't take off as quickly as other sectors following the passing of some of those programs. What sectors have you seen maybe, I don't want to say hit some walls, but maybe have just been a bit slower? And then how has that impacted your team's underwriting of investment opportunities within these subsectors?
Yeah, it's an interesting question just because I've been thinking about it a lot, and I think in some respects, 2 places, well, one place in particular that I would call out is hydrogen. And I think that there's a bunch of different things that are associated with that. The other one that I think about sometimes is biofuels. And I think in either circumstance, we've heard a lot of speakers today talk about clean molecules on either side of that coin. But at the same time, it's almost a question of these situations being a victim of their own success, maybe more particularly in biofuels. There was a huge rush when people realized that the energy transition was on. And so a lot of renewable diesel projects, a lot of renewable natural gas development, so on and so forth. And some of those support mechanisms had already been in place vis-a-vis the low carbon fuel standard, RINs, so on and so forth. But then when you think about things like the IRA or the Infrastructure and Jobs Act, the rollout of some of those programs has been slower, and I think the next tranche of support really does need to come from those programs. And in particular, if you think about the 45V program as it relates to hydrogen, or you think about the 45Z or Z program as it relates to biofuels, those are kind of the equivalent programs to what I think the electrification side has had for a while, just because they've had multiple years of PTCs. And so I think it's a really important point to make that I think this is a really hard thing for governments to deal with right now. I do think that some degree of, I hesitate to say this, but above market pricing or green premium is going to be necessary for some of these clean molecules. And I think a lot of people have said that today just because they are more expensive right now to produce. And so I think it's really hard to figure out how to tune these programs and how to execute on them if you are a government to meet the demands that you're trying to create on the other side of this. And then on top of that, you have electoral uncertainty, and we see that on both sides of the border. But I think one way or another, and we track this very closely at the Ontario Teachers Pension Plan, people are working through these issues, they're figuring it out. I think that there are a lot of really interesting things coming down the pike in terms of the support that we'll see for these areas. And look, like I think everyone's just trying to do their job. It's just we have to do it carefully, and that takes time.
Yeah. I want to pivot the conversation a bit, maybe direct these next topics to the founders and early stage management teams in the audience. Nishka, this one's for you. In order to achieve many of the global decarbonization milestones, there's going to be an enormous amount of capital that's going to be required to be put to work. So Nishka, what technical and commercial milestones do you typically look for when assessing an investment opportunity?
Thanks for that question. I kind of want to preface that question with a little bit of my background and just ARC's background in general, because private capital, there's so many pockets of capital with very different risk and return philosophies and different investment strategies. So I think it's just very important for founders and companies to find the right type of capital for their stage of business and get a lot of alignment with who their capital provider is going to be. So what we look for as a growth equity provider in the energy transition on the technical side is going to be very different than what a VC focused fund looks for. From a technical standpoint, ARC looks for either technically agnostic companies, which doesn't mean that there's not technology, because this is a technology-enabled transition at the end of the day. This is a policy-driven transition. A lot of capital will be required and can't shy away from building technology, but it's that binary risk of a singular technology. So either we're looking for tech-agnostic businesses that are really just taking commercial and execution risk in building their projects, or we're looking for just commercially proven technologies at the end of the day. I shy from giving TRL levels as part of my answer here, because that's really not how we think about it. We really just think about it as to what does the next 5 years of the business look like, what parts of the execution need to be de-risked, and technology de-risking just shouldn't be a massive part of that. On the commercial side, I think, again, every capital provider is going to have different expectations. We don't look for a specific revenue number or an EBITDA number. What we do say, though, is after our money has gone in, we want the company to be sustainable and profitable. Doesn't mean they're not going to raise another round of growth equity. Doesn't mean they're not going to IPO in the future. It just means that that needs to get them to a place where the company's now producing revenue, has some cash flow, and can sustain some of those low points that we're all going to experience in this transition, and isn't going to be on this sort of treadmill of constantly raising capital year after year after year. So I think those would be the most important commercial milestones. I think there's a set of conditions, right? Are we aligned on risk and return? Is the structure optimized? And one thing I will say is probably just like believable forecasts. There's a lot of hockey stick forecasts, not saying that that shouldn't be the case. We've all seen energy transition grow exponentially over the last 5 or 6 years. So if you have a hockey stick forecast, that's fine. But can you back that up with actual customer contracts or term sheets? Can you show, when you start to drill down at the monthly level, what the use of proceeds is going to be? Have you paid a lot of attention to how much it's going to cost to execute something? And can you essentially just deliver on the forecasts that are presented to the investor at underwriting?
Aaron, maybe piggybacking off that, where do you think founders and management teams typically go wrong when raising capital?
Yeah, I mean, I have a lot of sympathy for founders. I think a lot of people in this industry right now have to have a lot of courage. I'm not a founder, and I think sometimes it must be hard to fall asleep at night because there's all of these different things that you're managing at the same time, and it's kind of like flying a plane while you're building it in real time, and you hope that you've got both engines running the whole time too. I think on the flip side, it is really hard for investors. The energy transition is a really complicated area to invest into. We've talked about the importance of some degree of government support or above market support wherever you find that maybe it's customers recognizing that if they want these low carbon molecules or solutions, they do need to pay different type of premium right now. And then I think on the other side, and I think Nishka introduced this topic really well, is the concept of commercial readiness or technology readiness. And in my mind, to a certain extent, like even the concept of technology readiness level has so many different layers to it. You can talk about a plant, you can talk about a piece of kit, you can talk about the use environment, but I think that discussion, it epitomizes what a lot of investors are confronted with, which is there is a degree of novelty to a lot of the stuff that we're seeing. And so I take a step back and I always try to anchor myself in the example of solar and wind, and we're seeing it now in battery energy storage systems where this stuff started off very expensive, wasn't clear how deployable it was going to be. For folks like myself who were oil and gas investors, every once in a while we'd say, well, natural gas combined cycle generation is still cheaper, so please go away. But the advancements, not just in technology, but just in like supply chain deliverability and cost, were really quite staggering and have made those technologies or those solutions mainstays. And you can see that exponential growth continuing on. And so when I think about how to bridge from where solar and wind were once to where they are now and what that means from a founder's perspective and an investor's perspective and what kind of things you need to think through, the first place that I go to is brass tacks. Is there a revenue model which is going to economically support your business? And that's why the IRA exists, that's why the CFR exists, that's why 45Q exists, so on and so forth. And I just think the reality of the situation is you do need a revenue stack that, regardless of how mature your technology is, does paint a picture where you can see prospective economics either now or down the road as you scale your technology. The second layer of that relates to the concept of scaling itself. And other speakers have discussed this at length, and I think it's an intrinsic element of the energy transition. First-of-a-kind facilities are hard. I, again, have a tremendous amount of respect for the founders and the builders who are trying to execute on these types of technologies these days, because I mean, especially with high interest rates, this is not easy. But I do think one way or another, it's easy to say that we're just going to optimize supply chains and everything's going to get easier. But I do think that there's a potential need to have an articulation of how you're going to go from, your cost is X to your cost is X minus 50%. And there's a lot of different ways to think about that. Scaling your procurement contracts and having facilities that take advantage of larger synergies and economies of scale, and maybe there's other ways of partnering with other folks who are building facilities alongside you. It's just one way or another, if there is a scale-up question, then there's a whole bunch of other conversations that will need to take place so that people have confidence that this can become like wind and solar once were. And then you get into a topic which is sort of even more mundane than that, which relates to execution and operability. And it goes back to what Nishka was saying, which is, can you deliver on your forecasts? And again, I do think that there's a lot of need for investors to be conscientious of the challenges that builders and founders are experiencing in these situations. And you do need to pay attention to the vagaries of things like commissioning. Commissioning is the death of all things nice in the energy transition. But at the same time, at a certain point, a lot of these hockey stick projections that we see there, because we're going to take this shiny object and we're going to start to pump it out like hotcakes. Okay, well, that's great. Demonstrate how you can execute on one facility, being constructed at a time, 2, 5, 10. Show me your HR plan. Show me how you're going to do the commissioning. Show me the operations team that's going to come in behind that. What is the geographic consideration of having a project here versus a project on the other side of the country? Like, and I think a lot of folks who've had experience in oil and gas, we've all been grinded over the past decade to have that degree of operatorship in some respects, or you just didn't make it through. So I do think that it's worth considering. And then after all of that, you have everyone's favorite topics of valuation and terms and conditions. And so there could just be a market environment where perhaps there is a bid-ask spread for whatever reason. But I think what it all boils down to is just the partnerships that need to exist between sponsors and their investee companies need to have a degree of humility and understanding and collaboration, because you are dealing with a very difficult area to invest into. It's very technical, both from like a physical built environment perspective as well as from a regulatory or commercial perspective. And people need to kind of help each other reach across, and sometimes it's going to mean compromise. And so do you want to own 90% of something that may not be worth anything in the future, or do you want to own 50% of something that could be worth billions of dollars? I know it's not that simple, but I just think that it's an important question for everyone to reflect on.
Yeah, that was spot on. So we have a few minutes left. I do want to get to one last topic after this one, but Anishka, with the growing demand for data centers on the back of the current AI supercycle, corporates are increasingly looking for around-the-clock renewable energy supply. Maybe starting with you, Nishka, talk to us how your teams are allocating capital to this massive theme.
So we're an energy-focused fund, so where we plug into the whole data center opportunity is on that front end. Can we provide capital to developers that are building behind-the-fence power for data centers? I think we all know that it's very hard to transport chemical energy, right? Like whether that's building new natural gas pipelines, building hydrogen transportation, which is a massive challenge. And it's also very hard to upgrade our transmission systems at the scale that is required in order to deliver the power that we need to for this data center explosion. What is a little bit easier to do from a permitting as well as a cost standpoint is transmitting data, because fiber optics is a degree cheaper than building transmission lines or natural gas pipelines. So the way we're playing it is we actually have a portfolio company today that is looking at developing behind-the-fence power and pairing that with offtake from data centers that would be co-located with those power systems, with those power generation assets. The other place where we aspire to play is probably just the physical and digital assets that will be required to optimize the grids. Whether that's decongesting the grid or optimizing the grid. We're seeing a lot that's being done in Europe right now. North America, we haven't even started that, right, in many ways. Like we've decongested the medium to the high voltage side of the grid, or we at least know how to foresee what the problems are. When it comes to the medium to the distribution side of the grid, we don't have a lot of data visibility as to what's happening. And as more and more use or load is going on the other end of that distribution side of the grid, we're just going to need so much more optimization, whether that's physical sensors or software solutions. So that's another area that we're pretty excited about and would love to spend more time on.
Aaron, maybe 2 minutes. How are you guys playing this theme?
Just like Nishka said. No, I mean, like, glibness or not, I do think that she's touching on a lot of the sectors that people should be focused on. We do have a platform called Compass Data Centers, which does do full cycle data center delivery. And we have had previous investments which have focused on data center operation and leasing and whatnot. I think, like, part of what Nishka talks about are opportunities which are, focused very specifically on data centers and are unique to data centers, but then there's a whole bunch of just plain vanilla businesses to support that stuff too. One area that we've been spending a lot of time on, which unfortunately a number of other folks have been spending a lot of time on, are services and equipment providers that focus on the power sector. And everyone's favorite word down in Texas these days is substation or transformer. Texas is a wild place. The business models around these things called data center campuses is mind-boggling. And I think there's a lot to be said about just providing high-quality service to people who want fast execution, because there is a present value impact for the hyperscalers in terms of how fast these data centers come online. So I think that there's a lot of different ways to play the game. We're focused on a few specific areas right now, but I think the opportunity set's only going to grow.
Yeah. Well, maybe just wrapping things up, maybe if each of you can maybe just take a minute or two, what energy a year from now, what energy transition sector are we going to be talking about the most at next year's conference in 2025, and why? Maybe start with you, Nishka.
This is a 25 to 50-year transition, so year over year, we're probably going to be repeating a lot of the same themes, right? We're going to be in the rear view mirror looking at one major election, if not two, in Canada and the US. So there's going to be some policy certainty or uncertainty that comes out of it. So we're probably going to be discussing what the impact of all of that is on the various sectors that we've already touched on. I think everything grid related is just getting more and more intensely talked about and understood. So that's going to be a big focus. And then a little bit of what Aaron was saying when you asked the question about what's lagging. He brought up hydrogen, right? I think it's not lagging, it's just starting from a different base, right? We use a lot of power, we use a lot of electrons already, so we feel the increase in investment in those sectors a lot more, whereas hydrogen, the step change has been massive in terms of announced projects. It's just actual dollars in the ground, and production facilities will take some time to come through. So I think next year we'll be talking more about these sectors where projects have been announced, but hopefully by next year we're actually going to be talking about final investment decisions on many hydrogen and CCUS projects.
Aaron?
Yeah, I mean, I was tempted to say hydrogen and biofuels as well. I think it's well said, Nishka. Electrification has just benefited from just people needing power for things like turning light bulbs on. So those sectors have had a lot longer time to advance. And certainly aspects of them like EV charging or batteries, they're still a little more nascent, so to speak. But I don't think that they're on the same playing field as biofuels or hydrogen necessarily. I think that the use cases for those two areas together in particular is really powerful. Blue hydrogen is one of my favorite things. And I think that we're seeing a lot of developments south of the border and hopefully north of the border that will provide a pathway, hopefully 6 months from now, for people to really start engaging in those areas in a serious capacity. But I continue to see a lot of need for those kinds of solutions because we can only electrify so much so fast.
That's great. I think we're going to have to leave it there, unfortunately, folks. But why don't we give one more round of applause for Aaron and Nishka. How great were they?